Very good morning to all of you. Can you please confirm if the audio and video is clear to all of you? Can you please confirm if the audio and video is clear to all of you? Come on, guys. All clear? Uh, Wonderful. Wonderful. So, first of all, welcome to the marathon session of ACCA SBR. Now, first of all, I'll give you the agenda of this session, what exactly I'm going to do in this session, and then we will start our session. Okay. Now, let me write the agenda first of all. Okay. So as you know by the announcement that in this session we are going to study only group accounting and not other chapters. Okay. So it will be focused only on group accounting. Now, I want to utilize my time. I want to utilize my time in focusing the core SBR areas. I want to utilize my time by focusing on the core SBR areas. Okay. So now the group accounting for the which pertains to FR, I will not be discussing in this session. Okay, I will not be discussing in this session. Why? Because yesterday I took a marathon of ACCA FR wherein I have discussed the entire ACCA FR group accounting here. Okay, now so FR group accounting is already discussed here. Comes to SBR. Comes to SBR. So now what we will be doing here is we'll be doing the adjustments to purchase consideration. We'll be discussing here. What are the adjustments that we have to do the purchase consideration? Okay, now from an FR perspective, purchase consideration, we have discussed cash consideration. We have discussed contingent consideration, we have discussed deferred consideration, we have discussed fair value of share exchange. Okay, now from an SBR perspective, we'll discuss the adjustments to the purchase consideration. Further, we will discuss adjustments to net assets. We will discuss adjustments to net assets. Then further, we are going to discuss the treatment of goodwill or gain on bargain purchase. Okay. Then further, we are going to discuss what is the treatment of changes to group structure. Then we are going in changes to group structure, particularly we'll discuss step acquisition. We'll discuss loss of control. We will discuss purchase or sale without loss of control. Okay. Further, we are going to discuss here group cash flow. Group cash flow statements. Now, group cash flow statements is an important area, okay, and which we need to focus. And I will be discussing this group cash flow with the help of a question called as Kabilo company. With the help of a question called as Kabilo company, okay, which was asked in the December 2023 exam. Further, we will be discussing foreign subsidiary. We will be discussing joint operations. So this is what we are going to discuss here in this session. Okay. I believe it is clear to all of you. Now let us come to the session of SBR. So understand, from the purchase consideration point of view, just a minute guys, I think someone is spamming the lecture. Okay, now, yeah. So from the point of view of purchase consideration, please understand guys here, purchase consideration, basically investor company, the parent company has acquired shares of subsidiary company. But when is the audio not working? Guys, can you please confirm, is the audio working for all of you? Is the audio working for all of you? Wonderful, wonderful. Now understand, from the point of view of purchase consideration, please understand guys, what happens here, when the parent company acquires shares of subsidiary company, when the parent company acquires shares of subsidiary company, parent company has to give the consideration to the investee, has to give the consideration to the investee. Now this consideration can be given in multiple forms. Okay, now it can be given in the form of cash, it can be given in the form of shares of the parent company, it can be given in the form of deferred consideration, it can be given in the form of contingent consideration, it can be given in form other forms also. Okay, so now these four types of mode of consideration we have already discussed in ACCA FR. Okay, so I'm not discussing that part, because if you want to watch that part, I've already taken in the depth session in ACCA FR. Let us discuss the topic which is core to ACCA SBR. Now the adjustments to the purchase consideration comes here. Payment to the employees of acquiring company, payment to the employees of acquiring company. So understand, if the acquirer company, the parent company, pays any amount to the employees of the acquiring company, do we need to consider that in our investments balance or not? So the answer to that is yes, we need to consider. If it is paid for acquiring the shares held by the employees of acquiring company, if it is paid for acquiring the shares held by the employees of the acquiring company. But if the amount is paid to the employees for continuing employment, then that is not called as investments, that is not called as investments, rather that is called as salary cost or employee benefit expenses. Okay, or it's called as employee benefit expenses. Now so that's what is written here also. See, if it is paid for continuing employment, if it is paid for continuing employment, it is not a part of the cost of investments. But if it is paid in the capacity of them being shareholders, yes, it is forming part of cost of investments. Okay, notes, yes, the notes will be made available to you guys for the yesterday session and the today session. Both the notes will be available by today end of day. Okay, after the session. Coming to replacement awards. Now what is the meaning of replacement awards? So understand, let's suppose this is an acquirer called as Tata company, and this is an acquiree called as a Zomato company. Acquirer and acquiree, Tata and Zomato. Tata has acquired the shares of Zomato. Tata has acquired the shares of Zomato. Now understand, before acquisition of the shares of Zomato, Zomato has issued share-based payments under IFRS 2 to the employees of Zomato. Okay. Now, but when Tata acquires Zomato, Tata asks Zomato to cancel their share-based payment awards, and Tata will issue their own share-based payment awards to the employees of Zomato. Okay, this is called as the concept of replacement awards. This is called as the concept of replacement awards. So now understand, in the concept of replacement awards, what happens is the acquirer company issues its own share-based payments. The acquirer company is issued its own share-based payments. So now understand what is the accounting treatment in such case. So let us understand the logic behind this first of all. So let's suppose Zomato issues replacement awards or share-based payment awards to its employees, and the service condition is for 3 years. Service condition is for 3 years. In between, let's suppose after expiry of 2 years, Zomato got acquired by Tata. And now Tata says that I will issue the shares to the employees of Zomato. So understand who has received the services. Who has received the services? Zomato. But who has the obligation to issue the shares? Tata. So now what is happening here is Tata is issuing the shares to the employees of Zomato on behalf of Zomato, right? So it's like it is like Tata is settling the obligation of Zomato. So it will be added to the cost of investments. So what we do is we divide the replacement awards. Into two components. One is called as pre-combination award and one is called as post-combination award. Pre and post-combination award. Okay. Now under pre-combination award, what we will do is fair value of the original awards. What is the meaning of original awards? The awards issued by the share-based payment award issued by the Zomato company. Okay, the original awards multiplied by what is the period already expired till date of acquisition. What is the period already expired till date of acquisition? In our question, it was 2 years. Okay, divided by total vesting period. Now, how to calculate total vesting period? So total vesting period is higher of original vesting period or revised vesting period. Can you tell me what is the meaning of revised vesting period? So revised vesting period means expired period plus the revised period. Now understand, I want to explain this with the help of an example. So that you get a better clarity of the things. Okay. So let's suppose this is the date of acquisition. Original award had a fair value of 100. Vesting period was for 5 years. Okay. Now, after the expiry of 2 years, that this is the date of acquisition. Okay. Now, the replacement awards was issued by Tata. Now, Tata says, though the 3 years are still remaining, but Tata says to the employees of acquiring company that you are not required to service further 3 years. Just 1 year is sufficient. Okay. So how many years employees are required to service further? Only 1 year, not this. Okay. So now what is the value of pre-combination award? So it is fair value of original award 100 multiplied by what is the expired period till date of acquisition 2 divided by total vesting period, which will be higher of original vesting period, which was 5 years. Revised vesting period is equals to expired period, that is 2. What is the remaining vesting period? 1. 2 plus 1 is equals to 3. So what is the higher amount? 5. So the total vesting period will be equals to 5. So what is the amount? 100 into 2 by 5. 100 into 2 by 5. 40 will be added to the cost of investments. Is it clear to all of you? Come on, guys, tell me. Is it clear to all of you? Is it clear to all of you? Come on, guys, tell me. Wonderful. So this is the replacement awards. Though the question doesn't ask us, but if at all, the question asks us what is the value of the post combination award. If at all the question asks what is the value of the post combination award, then what is the value of post combination award? Post combination award is equals to fair value of replacement awards, fair value of replacement award minus pre-combination award, minus pre-combination, and this will be accounted as per IFRS 2 on share based payments. Is that clear, everyone? Is that clear, everyone? Okay, chalo. Now, so we have discussed the replacement awards. Now coming to the third part, that is called as reacquired rights. But this reacquired rights I'll be discussing once I have discussed this reacquired right will be discussed once I have discussed the net assets. After that I will discuss the reacquired rights also. Okay, coming back to my topic. Accounting world, what is the answer? Answer of what? Are you asking about pre-combination award? The answer is 40. 40. What is the journal entry of this? If you want to know the journal entry will be investments account debit to SBP reserve. Where will we record this SBP reserve? Where will we record this SBP reserve? So SBP reserve will be recorded in other equity. Okay. Now, okay, you are asking me the amount of post combination. See, I have assumed the figures. Okay. So now if I assume the figure of fair value of replacement award to be 120 and pre-combination award was 40. So the post-combination award is called as 80, which will be accounted for as per IFRS 2. I believe it is clear to all of you. Now I have a query coming up. What if Tata shares are worth more than the Zomato? Do we record as per IFRS 2 or expense it off in SP&L? Okay, now this is what I was discussing. Okay, now whatever is the value of Tata shares, tell me that is under a replacement award or that is under original award? Tell me. That is a replacement award because the shares of Tata are issued under replacement awards. So that will come under fair value of replacement award, right? Now, pre-combination award, we are calculating on the basis of fair value of original awards. Okay, so whatever is the fair value of the replacement award basis the shares of Tata minus whatever is the value attributed to the pre-combination, the difference of 80 is accounted for as per IFRS 2. So to answer your question, if the shares of Tata are worth more than the shares of Zomato, in that case the differential would be accounted for as per IFRS 2 and not P&L. Okay, it will be accounted for as per IFRS 2. Chalo. Now, if there is any acquisition related costs, what is the treatment of the same? So acquisition related cost goes on to P&L. Now, one more thing I want to discuss with you, though it is not there in the book, but ACCA has asked a question on it some time back. Okay, so I want to discuss on it. Okay, now in ACCA FR, financial reporting, if you can recall, I discussed something called as contingent consideration. Tell me yes or no. Which on the date of acquisition I recognize at fair value? Tell me yes or no. And the journal entry of this becomes investment account debit to contingent consideration at fair value subsequently. Subsequently, whatever are the fair value changes, it goes on to P and L, right? Now understand, this is the treatment that happens if you have to pay a fixed cash after fixed time, but there was a condition attached to it. That's what we studied in ACCA FR. Tell me yes or no. But now in ACCA SBR, we have one additional concept involved in this. Okay. Now, in place of cash, in place of cash, in place of cash, if the parent company says that I will be issuing equity shares of my company, I will be issuing equity shares of my company after 2 years, if this condition is met, if this condition is met, okay, so now in that case, okay, if the contingent consideration is to be settled in form of equity shares of parent company, then in that case we need to see that the number of shares is fixed, or the number of shares are variable. We need to evaluate this. Okay, if the number of share is fixed, applying the principle of IFRS 9 on financial instrument, it is called as, tell me what, equity. But if the number of shares are variable, then applying the principles of IFRS 9 financial instruments, it is called as financial liability. It is called as financial liability. Is this point clear, everyone? Is this point clear, everyone? Now, if it is financial liability, then the treatment is same as above. Same treatment as of cash. Same treatment as that of cash. But if it has to be settled in the form of equity, okay, that is number of shares are fixed, so in that case the treatment is different. In that case the treatment is different. And what is the treatment? So on date of acquisition, we record investments account debit to contingent consideration, and this will be forming part of equity. We recognize at fair value, but subsequently, do we need to remeasure and record fair value gain loss? No. Why? Because equity is never remeasured. Tell me guys, is that clear, everyone? Are you understanding this point? Are you understanding this point? Tell me guys, come on, all of you. Okay, guys, if you are understanding, I am focusing on the core SBR areas. I believe you are understanding and respecting that part. Okay, I'm focusing on the core SBR areas. Okay, now, so that you understand those parts, because FR part you can definitely manage on your own also. And if you want to revise FR part, there is already a session for that in that. Okay, you can watch in that part. So I'm focusing on the core SBR areas. Now, tell me, is it clear, everyone, till here? Is it clear to everyone till here? Wonderful. Now, so this discusses the adjustments to the investments. Now come to the adjustment to the net assets. Now understand, we know as per our FR understanding, that the net assets of the subsidiary are acquired at the fair value on date of acquisition. Tell me yes or no. We know that the net assets of subsidiary are acquired at fair value on date of acquisition, right? Now, there are few points which you need to be understanding. For self-generated intangible assets. Example you can say like customer lists. Example you can say brand name. Now tell me, applying the principles of IAS 38 on intangible assets, do we recognize this in our financial statements? Tell me, will subsidiary company recognize these in the financial statements? No. Why? Because even if they do have future economic benefits, but since there is no cost associated with it, we are not recognizing. Okay, but understand, when we are acquiring the subsidiary company, the parent company in its group financial statements, will recognize these as well at its fair value on date of acquisition, Okay, now second point is research costs. Now tell me, applying the principles of IAS 38, we know that the research cost, if incurred by an entity, is to be expensed off to P&L, right? But applying the principles of IFRS 3 on business combination transaction, what it says that whatever is the research cost incurred by the subsidiary company, prior to date of acquisition, okay, if that research has a value to the parent company, then that research is required to be recognized as an intangible asset. In the group financial statements at its fair value on date of acquisition. Is it clear? Okay. Third, contingent liability. We know that applying the principles of IAS 37, that is provisions, contingent liabilities and contingent assets, do we recognize contingent liability? No, we just disclose the contingent liability. But applying the principles of IFRS 3 on business combination, it says if subsidiary company has a contingent liability, then that contingent liability has to be recognized on the date of acquisition at its fair value on date of acquisition. It has to be recognized. So we need to create a provision for contingent liability. We need to recognize a provision for contingent liability. Now understand, whenever we are recognizing a contingent liability, we need to be mindful that we are recognizing the indemnification asset. Indemnification asset which should not exceed the amount of provision for contingent liability. Guys, there might be a question on this. Okay, question might tweak the adjustments from the indemnification asset point of view. So you need to be mindful that indemnification asset never ever can exceed the amount of provision. Indemnification asset can never ever exceed the amount of provision for contingent liability. Okay, so understand, indemnification asset okay, will always be either less than or equals to provision for contingent liability. Okay, then fourth, non-current asset held for sale. So now ideally the principle principle says that we are required to recognize the net assets of subsidiary at its fair value on date of acquisition. But if we are acquiring non-current asset held for sale, now will we recognize it at fair value on date of acquisition? No. Then we will recognize it at fair value less cost to sell on date of acquisition. Is that clear, everyone? Is that clear, everyone? Now, Rasmi has a query. What is the meaning of indemnification asset? Okay, so let me explain you the meaning of indemnification asset. So understand. Let's suppose there is a Nike store. Okay, there is a Nike store. Now, Nike store sells Nike shoes to the customer. Okay, now with a guarantee that if anything happens to the shoes within a period of 1 year, then the customer can return the shoes back to Nike and Nike will refund the money back to the customer. Okay, now let's suppose after selling the shoes, one of the customer comes back to Nike within a period of 6 months stating that the shoes are defective and it has to be replaced or a full refund has to be given. So the Nike store fulfilling its promise refunds the entire money to the customer. But now tell me, will Nike store bear that loss? Will Nike store bear that loss? No. Nike store will recover that money from the Nike company. Right? So whatever is the recovery that has to be done from the Nike company is called as indemnification asset. Now tell me, can the Nike store recover? Let's suppose Nike store has given a refund of $100 to the customer. Nike store has given a refund of $100 to the customer. Tell me, can Nike store recover more than $100 from the Nike company? Can Nike store recover more than $100 from the Nike company? No, right? It can recover up to $100 but not more than that. Are you understanding the meaning of indemnification asset? Safal, Rasmi, Bombal. Wonderful. Clear? Now I have to discuss one concept of reacquired rights. Do you know what is the meaning of reacquired rights? Okay, let me explain first of all the meaning of reacquired rights, and then I'll discuss what is the treatment of the reacquired rights from the investments point of view and from the net assets point of view. Okay, so let us understand the meaning first of all. So let's suppose Domino's as an entity given the franchisee rights of Domino's to a company called as JFL, Jubilant Foodworks Limited in India. Okay, gave franchisee for 8 years at an amount of $8 million. Now, JFL recorded this franchisee as an intangible asset, that is franchisee rights account debit to bank 8 million, applying the principles of IAS 38 on intangible assets. Okay, now applying the principles of IAS 38 on intangible assets, JFL Limited started amortizing it over a period of 8 years. Okay, amortizing $1 million every year. Amortizing $1 million every year. Okay, now after 5 years, Domino's realized that JFL is doing a wonderful business in India. JFL, Jubilant Foodworks Limited, is doing a wonderful business in India, and Domino's wants to set up its own company in India. So rather than setting up its own company, what Domino's did is Domino's acquired JFL Limited and made JFL as its subsidiary. So now understand, when Domino's acquired JFL Limited, in the books of JFL Limited, there is something called as franchisee rights. Recorded. So when Domino's is acquiring JFL Limited, Domino's is acquiring those franchisee rights also. Tell me yes or no. Domino's is acquiring those franchisee rights also, right? So effectively what is happening? Domino's initially issued the franchisee rights. Now Domino's is reacquiring those rights. So this is called as reacquired rights. Are you understanding the meaning of reacquired rights? Tell me, guys. Are you understanding the meaning of reacquired rights, all of you? Are you understanding the meaning of reacquired rights? Okay, now understand further the treatment. Okay, now these reacquired rights has to be recorded at fair value on date of acquisition. So basically in the group FS, these reacquired rights will be recognized at its fair value on date of acquisition. So adjust fair value of net asset, that is recognize fair value of the reacquired rights on date of acquisition. So this is the treatment from a net assets point of view. This is the treatment from the net assets point of view. Okay, now from the point of view of investments, the standard mentions we have to reduce the investment. We have to reduce the investments by the settlement amount. Now the settlement amount can be the penalty as per the contract or fair value on date of acquisition, whichever is lower. Okay, settlement amount is lower of penalty as per the contract and fair value on date of acquisition, whichever is lower is called as settlement amount, and we have to reduce the investments by settlement amount. We have to reduce the amount of investments by settlement amount. I believe it is clear. So let me write down the summary of it, of reacquired rights. The summary of it, the crux of it, the reacquired rights crux from an investments perspective and from net assets perspective. Recognize reacquired rights at fair value on date of acquisition in the net assets, and investments reduce by settlement amount. Now what is the meaning of settlement amount? Settlement amount is lower of penalty as per the contract and fair value on date of acquisition. Is it clear, everyone? Come on, guys, tell me. Sure. Wonderful, done. This concludes my net assets here also, SBR group accounting. Now coming to the next part, but before I come to the next part, I want to write here few things. ACCA FR perspective. Though I'm not covering it, but still I want to just give you a brief on it. Okay, from the point of view of Consol SOFP. Okay, from the point of view of Consol SOFP, understand what are the adjustments. You need to see what is the date of acquisition, you need to see what is the reporting date, you need to see what is the percentage acquired. Okay, you might need to rectify investments. I believe you are understanding the meaning of rectifying the investments. Risita, I'll come to your query, but let me first of all finish this part and then I'll come to your query. Okay, now you have to rectify the investments. Why do we need to rectify the investments? So now understand, parent has acquired subsidiary, and for acquiring the subsidiary, they have issued cash consideration and deferred consideration and shares exchange. But they have recorded only cash consideration. They have not recorded deferred consideration and they have not recorded share exchange. So we have to record it. Okay, that's the meaning of rectification of investments. Further, there can be certain adjustments that we have to do. And what are those adjustments? Adjustments can be fair value adjustments. Adjustment can be excess depreciation on fair value adjustment. Adjustments can be unrealized profit adjustment. Adjustment can be transfer of non-current assets. Adjustments can be intra-group loans. Adjustments can be contra adjustments. Adjustments can be contra adjustments. Adjustments can be contra, that is trade payable, trade receivable, and there might be an adjustment of cash in transit. There might be an adjustment of goods in transit. Okay, so all those adjustments are there. Now, adjustments can be dividend paid by subsidiary. Adjustments can be dividend paid by parent company, right? These are the adjustments, and all these adjustments I believe we discuss from an FR perspective. Okay, so now this is what you need to be careful about. Whenever you see the question on console SOFP, first of all, see what is the date of acquisition, what is the reporting date. Very important point. What is the percentage acquired, what is the NCI. Then rectify investments if needed. Then fair value adjustment has to be done on date of acquisition. Excess depreciation has to be adjusted in the post. Now, unrealized profit can happen from parent to subsidiary or subsidiary to parent. Okay, transfer of non-current assets, intra-group loans, contra adjustments, all these things are discussed in FR perspective. As mentioned, I am focusing specifically on SBR pertaining adjustments. Okay. Now, from console P&L perspective, understand here, guys, from a console P&L, guys, I'm strongly recommending you that you need to watch the FR part as well. Okay, respecting the time, I am discussing only the SBR part, but you need to focus on FR part as well. Okay, that's the reason why I'm giving you the complete list, so that you don't miss out on anything. Now, console P&L. So in the console P&L, you need to say that we take the parent plus subsidiary, multiply it with time adjustment. Okay, now, but do we multiply with the holding percentage? Tell me, do we multiply it with holding percent? No, we don't multiply it with holding percentage. Be very careful here. Now, what adjustments? What are the adjustments? Adjustments can be excess depreciation on fair value adjustment. Adjustment can be goodwill impairment. Okay, though I don't want to go into the depth of it, but tell me, what is the treatment of goodwill impairment? So as we have discussed multiple times in our classes also, we always say that the goodwill, understand, if NCI is at fair value method, the goodwill impairment has to be allocated to parent and NCI in the ratio of their holding. But if NCI is at proportionate share method, the goodwill impairment loss has to be allocated to parent only. Okay, then comes intra-group trading. What is the treatment that we do for intra-group trading? We reduce the whole amount of intra-group trading from revenue and cost of sales, and we add the amount of unrealized profit to the cost of sales. Then transfer of non-current assets, intra-group loans. For intra-group loans, we need to knock off finance income and finance cost. Okay. Then further, now dividend paid by subsidiary. Now, what is the treatment of dividend paid by subsidiary in console P&L? Dividend paid by subsidiary in console P&L. So understand, in the individual FS of parent company, parent company would have recorded the dividend that is received from the subsidiary company as an income. But when we are preparing the group FS, so what does it mean? What is a group FS means? It means that the parent and subsidiary are single economic entity now. Parent and subsidiary are single economic entity now, right? When the parent and subsidiary are single economic entity, can it recognize income among themselves? No. So it is like I am transferring the money from this pocket to this pocket. Will I recognize any income? No, it is not an income. So hence, what we have to do is we have to reverse the income recorded by the parent. We have to reverse the dividend income recorded by the parent company, okay, which it received from the subsidiary. Dividend by parent, any treatment in console P&L? No. No treatment in console P&L. Okay. Now, further, one more thing happens here is allocation of profit to parent and NCI. Now, how do we allocate the profit to parent and NCI? So basically, when allocating the profits to parent and NCI, so what we do, we first of all take what is the profit earned by the subsidiary company in the current year. What is the post acquisition profit for the current year? Let me explain this with the help of example. Let's suppose I acquired, date of acquisition is this one. Okay. Now my year starts from 1st January 20x1. My date of acquisition is 1st April 20x1. And my year end is 31st December 20x1. Vipul, yes, all these are discussed in detail in FR lecture, but still I'm giving you a brief of it. Okay. If you remember that part, you are not required to watch FR lecture. Okay. If you still want to revise the FR part, you can go and revise in the FR part. Okay. But in this lecture, I am strictly sticking to the SBR adjustments only, but still I am giving you an overview of the FR part as well, so that it becomes a refresher to all of you. Okay. Now, understand. So this is my date of acquisition. This is for the entire year. Now, if you have to calculate the profit attributable to NCI, and the question says that for the entire year, the subsidiary company has earned a profit of 100. So what will you do? First of all, you will calculate what is the post acquisition profit. So you will do 100 multiplied by 9 by 12. This is the post acquisition profit. Then you will adjust this profit for all the adjustments given in the question, but which impacts the profitability of subsidiary company. The adjustments which impacts the profitability of subsidiary company will adjust the profit for this and calculate the adjusted profits, and then calculate the share of NCI, and this is the profit attributable to NCI. Rest everything is for the parent company. But now understand, a common mistake made by the students in the exam is, let's suppose question says like this: 1st January 20x1. Date of acquisition is 1st April 20x1. Year end is 31st December 20x1. The question is giving you the data of 20x2. Now tell me, will I take, when I'm preparing the console P&L, am I preparing from here to here, or I'm preparing the console P&L from here to here? Tell me. The console P&L which I'm preparing, is it for this period? The console P&L which I'm preparing, is it from this period to this period, or it is from this period to this period? Tell me, guys. The console P&L is for the year, means it is for this year. So when preparing console P&L, be mindful of this part. Be mindful that it is not from here to here. It is only from here to here. It is only for that particular year, not cumulative from date of acquisition till reporting date. Be mindful of this part. Okay. Now, coming to the acquisitions and disposals. Coming to acquisitions and disposals. Now, step acquisition. Step acquisition. First thing is step acquisition. So as I have promised here, come here. Okay. So we discussed here adjustment to purchase consideration, adjustment to net assets. Now, treatment of goodwill or gain on bargain purchase. Tell me, do you know how to calculate goodwill? Do you know how to calculate goodwill? So goodwill is calculated as investments plus value of NCI on date of acquisition. It can be as per fair value method or it can be as per proportionate share method, which is specified in the question, which will be given in the question. If question is silent, we consider it at proportionate share method. We consider it at proportionate share method minus fair value of identifiable net assets on date of acquisition. This will give you the, if the amount is positive, it is called as goodwill, which we recognize as a non-current asset in the SOFP. Okay. If the amount is negative, it is called as gain on bargain purchase, which is recognized as an income in consol P&L. Is it clear, everyone? So now this part is also done. This part is also done. Tell me guys, is it clear? Now I think someone asked me, Risita asked me a query. Why will there be a penalty for a reacquired, right? Risita asked me, why will there be a penalty? Now understand, whenever a contract is signed, don't you think in the contract there is a penalty clause if any party cancels the contract? Tell me, Risita. If any party cancels the contract, there is a penalty clause in every contract, right? Now, when the Domino's company acquires Jubilant Foodworks Limited, okay, don't you think Domino's company is canceling the contract? Don't you think Domino's company is canceling the contract? Tell me. Right? So on cancellation, it will give rise to a penalty. It will give rise to a penalty. It will give rise to a penalty. Come on, guys, tell me yes or no. On cancellation, it will give rise to a penalty. Clear, Rishita? Chalo, wonderful. Coming back to my notes. So anyone have any further queries in these three parts? Please confirm, or if not, I will move on to the next part, that is changes to group structure. Changes to group structure. Can you please tell me, anyone having any queries in these three parts? Swayam, you will get these notes. The link of the notes will be given in the description box after the class. I will give the link. You can download the notes from that. Okay, you can download the notes from that. Coming to the next part, that is changes to group structure. What is the meaning of changes to group structure? Okay, understand. It means previously we were not a subsidiary, but we become subsidiary now. We become subsidiary now. Okay. Second part, we were a subsidiary, but now we are no more a subsidiary now. Okay, now we are no more a subsidiary now. We are no more a subsidiary now. Third is, we were a subsidiary, now also we are a subsidiary. Understand these three things first of all with the help of an example. Let's suppose I previously had 10%, I acquired 45%, become 55%. I became subsidiary. Okay, I became subsidiary. Situation number 1. This is called as a case of step acquisition. Second part, I was having 55% holding, means I was a subsidiary, but I disposed of 45% and I came back to 10%. Okay, now it is called as loss of control. It is called as loss of control. It is called as loss of control. Third thing, I was having 80%, meaning thereby I was a subsidiary. Meaning thereby I was a subsidiary. Okay, now, okay, or let's suppose I was having 55%, meaning thereby I was a subsidiary. Now I acquired additionally 25%. So how much it became? 55 plus 25, 80%. Now still I am a subsidiary. Still I am subsidiary. So it is purchase or sale without change of control. Without change in control. Now understand. Situation number 4. I was having 80%. I was a subsidiary, but I disposed of 25%. I came back to 55%, but still I am a subsidiary. It is called as purchase or sale without change in control. It is called as purchase or sale without change in control. Okay. So now we have to understand and study these 4 things here. Okay. So effectively it happens. One is step acquisition, one is loss of control, and one is purchase or sale without change of control, is the 3 things which we have to study primarily in the acquisitions and disposals. Okay. Now, Swayam has a query. Sir, one query. I was doing a question in the study hub and in it parent gave goods to subsidiary on year end, and as per the rule we subtract the full amount of intra group trading with revenue and cost of sales. Okay, yes, but they only subtracting the URP part and there was no subtraction from revenue and cost of sales. Can you, if time, can you take that question? Not in this class, but definitely I'll tell you the treatment of it. See, understand, if there is an intra-group trading between parent and the subsidiary company, definitely the whole amount of intra-group trading has to be adjusted from revenue and cost of sales. From revenue and cost of sales. Okay. Now, what you can do is you can share that question with me in the WhatsApp. I believe you have my WhatsApp number. Please share that. Okay. Or preferably in the Telegram group. Okay. Personal messages might get missed. Personal message might get missed. So please send your query in the WhatsApp Telegram group or the WhatsApp group. Okay. I will look into that query also. Okay. Now, let me explain you the accounting treatment of step acquisition, loss of control, and purchase or sale without loss of control. So understand. Now, in case of step acquisition, what do we do? So in case of step acquisition, the standard says that we remeasure the previously acquired interest on the date of acquisition. We remeasure the previously acquired interest at fair value on date of acquisition, and any gain or loss is to be recognized and P&L or other comprehensive income as the case may be. Is that clear, everyone? Tell me. Sir, then what is the further treatment? The treatment is same. The treatment is same. Okay, Mr. Kannada Blasters, the link of the Telegram group is given in the description box. Okay, if not, then I will post the link of the that group in the description box after the session. Okay. So understand, the overall treatment of subsidiary company is same as what we discussed. Only additional thing which you have to do in case of step acquisition, only additional thing which you have to do in the case of step acquisition is you have to remeasure previously acquired interest. You have to remeasure previously acquired interest at its fair value on date of acquisition. Okay, and then calculate the value of investments. Is that clear, everyone? So let me explain with the help of an example. Let's suppose on this date I acquired 10% at an amount of 15. Here I acquired 20% at an amount of, let's suppose, 35. Okay. Now here I acquired 40% at an amount of 120. I acquired 120. Vipul, no. This is what is relevant for SBR. First of all, go with me all the SBR adjustments with me here, okay? And then watch the FR part, that gaps will be filled there, okay? The gaps will be filled there. Primarily, you have to focus on this only. Primarily, you have to focus on this only for the SBR. Okay, Vipul? Now understand. So now this is a case of step acquisition. Now tell me, what is the date of acquisition? So your this is called as your date of acquisition. Why? Because you are gaining the control on this date. So now what you have to do on this particular date, you have to re-measure these here at the fair value. So now the fair value of this one, the fair value of this one here is, let's suppose 42. The fair value of this is, let's suppose here is 21. This one is 21. So now this is the value of the investments. Now this is the value of the investments. Now 120 plus 42 plus 21 is 183 is the value of investments. Now we will use this value of the investments to calculate goodwill or gain on bargain purchase. Okay, now the gain 42 minus 35 will go to P&L. 21 minus 15 will go to P&L. Is it clear, everyone? See, that's what I have written here. Any gain or loss on fair valuation of the previously acquired interest is recognized in consol P&L. It can be recognized in consol OCI also, when if the entity, if the parent company has a policy of measuring it at FVT OCI. Measuring it at FVT OCI, then we can measure the remeasure gain on loss to OCI, otherwise to P&L. Otherwise to P&L. Okay. Now coming to loss of control. Coming to loss of control. Though I have discussed the loss of control in the FR in detail, but still I am discussing it again here, okay, because it is relevant for SBR as well equally, okay. So I'm discussing it in depth here as well. So understand now, tell me. Please tell me here one concept. When you acquire control, what is the entry that you pass? You recognize net assets. You recognize net assets. You recognize non-controlling interest, right? You de-recognize purchase consideration, or which we call as investments, and the difference is called as goodwill. Recognize goodwill, I can say. Recognize goodwill, I can say. Difference is we recognize goodwill. Right? Now on the date of disposal, on the disposal date, we do just the reverse. We de-recognize net assets. We de-recognize NCI. We de-recognize goodwill. We recognize sale proceeds. If there is any investment retained. Sir, what is the meaning of investment retained? See, understand. 55%, I sold 45%, but I retained 10%. I retained 10%. Okay. So now it is called as retained investments. So recognize investments retained at its fair value on disposal date, and the difference goes to P&L. Difference goes to P&L. Tell me, is the treatment of disposal clear to all of you? Is the treatment of disposal clear to all of you? Is the treatment of disposal clear to all of you? Come on guys, tell me. Is the treatment of disposal clear to all of you? But now, I have an important point to identify. Mr. Only Life, I will answer to your point also. But first of all, I'm in the mid of a topic, so let me complete it, and then I'll answer your part also. Okay. So understand, this is the treatment has to be done in the console P&L, in the console financial statements. This treatment has to be done in the console financial statements. This treatment has to be done in the console financial statements. So you have to read the question carefully. Is the question asking for, is the question asking for console FS or the individual FS? If the question asks for console FS, you have to give this treatment. If the question asks for individual FS, if the question asks for individual FS, then in that case, what you will do, what is the treatment that you give? So in the individual FS of parent, in the individual FS of parent, you recognize sale proceeds, bank account debit, sale proceeds, you recognize sale proceeds, you recognize sale proceeds, you de-recognize entire investments. Okay, you recognize investments retained at its fair value on date of disposal, and the difference goes to P and L. This is console P and L? No, it is individual P and L of parent. It is individual parent of individual P and L of parent company. Divya Vad is asking the difference of what? The difference of this. The difference of this. See the journal entry. See the journal entry. Bank account debit, we are recognizing sale proceeds. NCI account debit, we are de-recognizing NCI. Investments retained account debit, we are recognizing the investment retained at its fair value on the date of disposal or loss of control. We are de-recognizing goodwill, de-recognizing net assets. The difference of this goes to console P&L. The difference of this goes to console P&L. Is it clear to you now, Divya? Is it clear to you now, Divya? Is it clear to you now, Divya? Tell me. Is it clear? Is it clear? Bhumika, it will go to P&L, not OCI. It will go to P&L. The difference is shown in equity. You would have solved the step acquisition case. Okay, you would have shown the step acquisition case, or that question would have been a question of console SOFP. If it is a question of console SOFP, are we preparing console P&L? Are we preparing console P&L? No. So where will we record the gain or loss? Where do we record gain or loss? Console retained earnings. So are we preparing console P&L? No. So where will we record this gain loss? Console RE only, na? Okay. Are you understanding it? See, understand, this gain or loss will go to console P&L. But if in the exam a question on console SOFP comes up, if in the exam a question on console SOFP comes up, will you separately prepare console P&L just to show this item? No. Where is the profit accumulated? Console RE. So where will we record this? Console RE. Okay. So this is a case of disposal of or disposal of subsidiary or loss of control. Now there is one more case of deemed disposal. Though the treatment is same in the case of deemed disposal also, but you need to understand the situation of or the meaning of deemed disposal. So let me explain the meaning of deemed disposal. So let's suppose this is a subsidiary company and this is parent company. Parent company acquired 80 shares out of 100 shares of the subsidiary company. Okay, so now parent company had 80% holding in the subsidiary company, meaning thereby it was a subsidiary company. Okay, now what happened? Now going forward, subsidiary company issued additionally 200 shares. Subsidiary companies issued additionally 200 shares. So now what is the total number of shares? 300 shares. Out of which, how many shares I have? I have only 80 shares. So what is the percentage that I have? 80 by 300. 80 by 300. That means I have only 27 percentage now. Okay, so my percentage is reduced from 80 to 27. It means what? It means what? So it means it is a case of disposal of subsidiary or a case of loss of control. Disposal of subsidiary or a case of loss of control. I believe you are understanding this. So in this case also, what is the treatment that we do? We de-recognize net assets, we de-recognize NCI, we de-recognize goodwill, we recognize sale proceeds, we recognize the investments retained at its fair value on the disposal date, and the difference goes on to the P&L. Difference goes on to the console P&L. If it's a question of console SOFP, the difference goes to console retained earnings. I believe it is very much clear to all of you. I believe it is very much clear to all of you. Come on, guys, tell me. Okay, now one FR student is asking me, if I saw your yesterday FR marathon and preparing for FR, should I watch only that and go for? Okay, now, so in the yesterday's FR marathon, I discussed group accounting, I discussed taxation, the important topic, okay, and I discussed financial importance, the overall key and the complex topics. Okay, so if you watch that plus my 8-hour whole syllabus revision video, it is more than sufficient. Plus I have also taken a separate session on the super 30 questions or and highlighted the other important questions. If you do all those things, it is more than sufficient for your ACCA FR in the times, in the considering the remaining time. Now coming back to SBR, is this 200 share issued without permission of parent company? No, it can't be done. No, it can't be done. It can't be done. Sandesh, it cannot be issued without the decision of parent company, without the permission of parent company. Definitely parent company would have approved the same. Okay. Now, coming to the third part, that is purchase or sale without change of control. Without change of control. So now what is the meaning of it? I had 80, I disposed of 25, I became 55. Previously also I had control, now also I have control. Okay, now I had 55, I acquired 25, I became 80. So previously also I had control, now also I have control. Okay, so this is called as purchase or sale. Here I have sold, here I have purchased. Purchase or sale without change of control. Purchase or sale without change of control. Okay, now what is the treatment in this case? So understand, if there is no change of control, do we recognize goodwill or gain on bargain purchase on this purchase? No. So ideally it is called as when there is no change of control. When there is no change of control, ideally it is called as that only NCI changes. Only NCI changes. So understand, if I am purchasing shares, so what is happening? If I was having 55%, means my NCI was 45%. Now, if I acquired this 25% and became 80, how much is my NCI now? Only 20%. So from 45 to 20, my NCI reduced. So this is case of reduction of NCI. So now when your NCI is reducing, what is the treatment which you do? So it is, since you are purchasing, you will pay to bank. NCI is reducing, so debit NCI. So NCI account debit and reduce NCI proportionately. Reduce NCI proportionately. That this is the amount of NCI for 45%. This should be the NCI for 25%. Reduce that amount of NCI proportionately. This is the amount that you have paid, and the difference is called as gain or loss on reduction of NCI. Gain or loss on reduction of NCI. Now comes the question, where will you record this gain or loss? Where will you record the gain or loss? This gain or loss will be recorded in other equity. This gain or loss will be recorded in other equity. Okay, now understand. A query is coming up how to calculate NCI for this. So as I was telling, see, on this particular date, you will calculate NCI normally, however you calculate. Okay. You will calculate NCI normally. You will calculate NCI normally. Let me write it off here. NCI, whatever is the NCI, okay, divided by 45% multiplied by 25%, multiplied by 25%. This is the amount by which NCI will reduce. Okay, you have purchased, so you will debit to bank, so credit to bank. Okay, you will reduce your bank account, and the difference will go to other equity. Now a question is coming up, sir, why other equity? Because it's a transaction between equity participants. It's a transaction between two equity participants. It's a transaction between two equity participants, the parent of the subsidiary and the NCI of the subsidiary, both holding equity shares of the subsidiary. Understand? This is subsidiary, this is parent, this is NCI. So don't you think parent also holds shares of subsidiary, NCI also holds share of subsidiary, so they are equity participants. They are equity participants of subsidiary company. So for any transaction done between them, any gain or loss that arises will go to equity, will also be adjusted from equity. Is that clear? Is that clear, everyone? Wonderful. Now, if you are selling your shares, if you are selling your shares, means this case, okay, let me do one thing. I write here this one, I write this here, this one. If you are selling your shares, means your NCI increases. Means your NCI increases. So earlier you had an NCI of 20%. Now you have an NCI of 45%. Your NCI increases. Your NCI increases. So now when your NCI increases, will you increase the NCI proportionately? No. 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 So how to record this one? So you will say, what is the value of net assets? What is the value of net assets, including goodwill, on sale date, multiplied by percentage increase of NCI, multiplied by percentage NCI. Okay, so this is what is the value of NCI by which we should increase the NCI. This is the amount by which we should increase the NCI. Sale proceeds will be debited to bank, and the difference will again go to other equity. The difference will again go to other equity, other equity. Is that clear, everyone? Is that clear, everyone? Is the other equity and share premium same? No, Sandesh. Share premium is one of the components of other equity. So other equity has what? Retained earnings. Other equity has what? Share premium, revaluation surplus. Okay, equity component of the compound financial instrument. Okay, equity component of the compound financial instrument. Okay, so whatever are the reserves and surplus, everything is called as other equity. Account, Mr. ACC world, NCI increasing means control decreasing? No. Understand? I see what I'm telling here. There is no change of control. There is no change of control. Control, see, understand, control is not measured in the form of percentage. The answer to the control is either yes or no. Okay, irrespective of whether I have 55%, 80%, or 100%, control is yes or no. Okay, now, so what is the meaning of 55%? It means ownership. Your ownership is increasing, your ownership is decreasing, but the control remains intact. When this is the case, we will not record anything in console P&L. Nothing will be recorded in console P&L in this case. Okay. Other changes in group structure is also transaction between equity holders. No. Why? Why is it the transaction between equity holders? Tell me now. Okay, tell me. How come? Here, understand, in the case of step acquisition, I am gaining the control. So there is something change happening in the control thing. In the case of disposal subsidiary, I am losing the control. There is something change happening in the control thing. That's when the impact goes to P&L. But here, there is no change of control. Here, in this case, there is no change of control. There is no change of control that happens. Okay, so the impact will not go to P&L. Now, coming to our discussion agenda, we have discussed changes to group structure, step acquisition, loss of control, and this one also. Okay. Now I'm coming to group cash flow. I'm coming to group cash flow. Okay. Now this group cash flow, as I told, I will be discussing this group cash flow by way of a question called as Kabilo company. Okay. This group cash flow I will be discussing with the help of a question called as Kabilo company. So let me show you the question. Let me show you the question. Till then, a query is coming up in a situation where control is not lost, the impact is recorded in other equity. Other equity, yes, yes. Parent can also buy instead NCI. Jeet Sarkar, I'm not getting a query. Okay. Now. Okay. So if you want to discuss the loss of significant influence also, I'll discuss that. No worries. Just give me a minute. I'll discuss that part also. Okay, loss of significant influence. So in case of loss of significant influence, okay, in case of loss of significant influence, like example is I had 40%, now I am left with 15%. So 40% means I was an associate, I had a significant influence. Okay, coming to 15% means the significant influence is lost, it is no more an associate, it is a normal investment. So in this case, we recognize the investment retained at its fair value on the date of disposal. We de-recognize the investment and the impact goes to P&L. The impact goes to P&L. Okay, the impact goes to P&L. The sale proceeds will also be recognized here. Bank account debit for sale proceeds. For sale proceeds. Okay. Now, coming to Kabilo company. Just give me a minute. I will change my screen for that. Desktop sharing. Can you see Kabilo company question? I'll increase the font size. Guys, can you please confirm if you can see the question? ACCA practice platform on the screen. Can you see ACCA practice platform on the screen? Guys, you need to confirm. Can you see ACCA practice platform on the screen? Wonderful. So now I have switched my screen and I am discussing consolidated cash flow with the help of this Kabilo company. Okay. And understand, console cash flow is an area where most of the students tend to make mistake. So be very careful. Okay, and listen to me carefully. Listen to me carefully. Okay, through this question, I am also helping you understand how exactly you need to read the question in the exam. Okay, and what should be the right approach of solving questions in the exam. So understand, whenever you come to an exam platform, what you have to do is first of all read the introductory paragraph. This is called as introductory paragraph. First of all, read the introductory paragraph. Okay. Now, Kabilo company is a parent company of the group whose financial year ends on 31st December 2005, and always highlight the reporting date. Always highlight the reporting date. The following exhibits available on the left hand side of the screen provide information relevant to this question. Okay. Now guys, understand, this Kabilo company is a past paper question of December 2023. Okay. The following exhibits available on the left hand side screen provide information relevant to the question. And what are the exhibits now? So it is talking about the exhibits. acquisition of Trudeau's company, financial instruments, and the console statements. Now this is the introductory paragraph of the question. Now a mistake which students will do is they will directly jump to the exhibits. No, you are not required to jump to the exhibits now. Rather, what you are required to do is jump to the requirements. Now jump to the requirements and copy the entire set of requirements. Copy the entire set of requirements. Copy. Close down the requirement folder, open the word processor and paste the entire set of requirements here. Format it a little bit. Format it a little bit. Okay, format it a little bit. Okay, I believe we are done with the formatting part. Now understand. Now, see, what you have done is you have saved your time of unnecessarily going back to the requirement tabs time and again. Okay, so you pasted the entire set of requirements here itself. Okay, and now what you have to do is read the requirements and then according to the need of the requirement, move to the exhibits. According to the need of the requirement, move to the exhibits. Okay, now, the agenda of taking up this question is to discuss the consolidated cash flow. So I am discussing only A1 part to discuss the consol cash flow. Okay. Now, so just read the question. Using exhibit 1, adjust the pre-populated spreadsheet to prepare revised extracts of the operating and investing activities of the console cash flow for the Kabilo Group for the year ended 31st December 2005. Okay, so basically the question is saying that we have given you the draft console cash flow. Okay, now using exhibit 1 you have to make the final console cash flow. So basically using exhibit 1 we have to make some adjustments to the cash flow and make it final. We have to make some adjustments to the cash flow and make it final cash flow. Okay, this is what we are required to do. Now tell me, in the draft cash flow given, will we adjust it for exhibit number 2? Will we adjust it for exhibit number 2? No. Why? Because the question says what? Using exhibit 1, adjust the pre-populated spreadsheet. Using exhibit 1, adjust the pre-populated spreadsheet. So that means that we are not required to adjust exhibit number 2 in the cash flow, and that's what is the benefit of reading the requirements and then according to the need of requirements moving to the exhibits. According to the need of the requirements moving to the exhibits. Tell me, is it clear, everyone? Are you understanding the right approach of solving a question? Okay, so here what I will write is refer spreadsheet. That's all. Now tell me, am I going to explain my workings? Am I going to explain my workings here? Come on, tell me. Am I going to explain my workings? No, I'm not. Why? Because the question says what? Adjust the pre-populated spreadsheet to prepare revised extracts of the operating and investing activities of the console cash flow. Is it asking me to explain? No, it is not asking me to explain. So for this part, I am not going to explain anything. Read the requirement number 2. Explain the adjustments required to correct the operating and investing activities. Means here I have to explain the workings which I have done here. So here in part 1 I have to do the workings. In part 2 I have to explain my workings. Is that clear, everyone? Are you understanding the requirement now? All of you, come on guys, tell me. Are you understanding the requirements now? Okay. Now let us close this window, open exhibit number 1. Open exhibit number 1 and read exhibit number 1 now. Read exhibit number 1 now. Okay. Now, Kabilo company acquired 80% of the 100,000 equity shares of Trudeau's company on 30th June 2005. Now, understand, this 31st December 2005 was the reporting date, and this 30th June 2005 is the date of acquisition. It is date of acquisition. It is date of acquisition. It is date of acquisition. Okay. Now, so meaning thereby we have acquired a subsidiary during the year. We have acquired a subsidiary during the year. Now, the consideration consisted of a cash payment of 5 per share acquired and issue of one Kabilo company for every 4 shares acquired in Trudeau's company. Kabilo's policy is to value non-controlling interest at fair value on the date of acquisition. Now, fair value per share of the Kabilo and Trudeau's on 30th June 2005, that is the acquisition date, is 13 and 8 respectively. Okay. So now 13 will be used to calculate the fair value of share exchange and 8 will be used to calculate the fair value of NCI. Is that clear, everyone? Is the first paragraph okay for everyone? Is the first paragraph okay for everyone? Is the first paragraph okay for everyone? I need answer from all of you guys. Come on, please tell me. Is the first paragraph okay for everyone? Now, the carrying amount of the net assets reported by Trudeau's on 30th June 2005 were as follows. So now it says the subsidiary had following net assets. Subsidiary had following net assets. Okay. The only fair value adjustment on acquisition related to plant which had a fair value of 50,000 above its carrying amount. It says this property, plant and equipment had a fair value adjustment of 50,000 on date of acquisition. Okay. The group pays tax at the rate of 30% and deferred tax was correctly accounted for within the consolidated statement of financial position. The taxation figure in the statement of profit or loss is this much, and this figure has been included as taxation paid within the draft statement of cash flows. Is it clear? Is it correct? Tell me, is this correct? So this line basically says that we have recorded a tax expense of 385,600. And this is the amount which we have recorded in the console cash flow as tax paid. Meaning thereby, can tax expense and tax paid be same? Can tax expense and tax paid be same? Ideally, no. It is not the case that it can't be same, but ideally no. So now here we need to evaluate. Here we need to evaluate whether the tax paid and the tax expense is same or different. Okay. Here we need to evaluate the same. Now the next part. Let's read the next paragraph. Okay. The group financial controller has accurately completed the console statement of financial position and console statement of profit or loss and other comprehensive income. So it says the group financial controller has accurately completed console statement of financial position, console P&L, other comprehensive income. All these three are perfect, but the console cash flow is in draft stage, so which we need to rectify. Console cash flow is in draft, which we need to rectify. The financial controller has not yet considered the impact of acquisition of Trudeau's company on the console statement of cash flows. Okay. The statement of cash flows figures where movements in inventories, trade receivable, trade payable, property, plant and equipment have been calculated by considering simply the difference in the year-end balance in the consolidated statement of financial position from opening and closing. Goodwill of Trudeau's company was impaired during the year. Okay. By how much? Not given in the question. There were no other goodwill impairment within the group. Okay. So only impairment of goodwill is of the Trudeau's company. Depreciation charge of the group is 625,060. There were no disposals of current assets by the group during the year, although there were some additions paid for by cash. So now tell me, how are we going to start? So let us open the spreadsheet. Let us open the spreadsheet and start working on one by one. So now the struggle which you will face is, sir, where to start from? Where to start from? So now start from the first paragraph. Start from the first paragraph. You have investment, you have NCI, you have net assets, calculate goodwill, calculate goodwill. Working note number 1, calculation of goodwill. Calculation of goodwill. Okay, so first of all, let us calculate investments. Investments are done in two forms: cash consideration and fair value of share exchange. Okay, now what is the amount? What is the amount? Can you please calculate? Tell me. We have acquired 80% of 100,000 shares and we have paid 5 per share acquired. So 80,000 into 5 is what we have to pay cash. So cash consideration is total number of shares of subsidiary companies 100,000. We have acquired 80%, and for each share acquired, we are paying $5 in cash. Now, what is the fair value of share exchange? So we have acquired how many shares? 100,000 ka 80% is what we have acquired. Now, how many shares we are issuing? So what is the exchange ratio? 1 share for every 4 share acquired. So multiplied by 1 by 4. Okay. Now, what is the fair value per share of? Now tell me, we'll take the fair value per share of Kabilo company. Kabilo company, that is 13. So multiply it by 13. So this is the fair value of share exchange. So let us calculate. So this is equals to 100,000 or 80,000 into 5. 80,000 into 5. Here this is equals to 80,000 by 4 into 13. Okay, now, so what is the value of investments? What is the value of investment? Equals to this plus this is 660,000. This is the value of your investments. Now, what is the fair value? So I believe the question was saying that the NCI is at fair value. Okay, Kudos Kabilo company policy is to measure NCI at fair value on date of acquisition. Okay, now how to value fair value of NCI on date of acquisition? It is equals to how many shares NCI will have? 100,000 ka 20%. 100,000 ka 20% multiplied by what is the fair value per share of Trudeau's 8. 8. $160,000. Now, what is the fair value of identifiable net assets on date of acquisition? On date of acquisition. So now tell me, what is the fair value of net assets? What are the net assets on date of acquisition? Tell me, guys. So net assets are 747,600, 747,600, 747,600. Plus there was a fair value adjustment of 50,000. Now, if there is a fair value adjustment that we have done, don't you think it gives rise to a temporary difference? Don't you think it gives rise to a temporary difference? Right? Because this fair value adjustment is done in the accounts books. It is not done in tax books. So it gives rise to a temporary difference. Now, what is this temporary difference called as? Taxable or deductible? Since the carrying amount of the asset increases, okay, it is a taxable temporary difference. So we need to create a deferred tax liability on the same. What is the tax rate given in the question? 30%. So what is the deferred tax liability? So right here, plus fair value adjustment minus deferred tax liability. 30% of 50,000 is 15,000. So what is the value of net assets? It is equals to 747,600 plus 50,000 minus 15,000 is 782,600. Okay. So now what is the value of goodwill? What is the value of goodwill on date of acquisition? It is equals to this plus this minus this, 37,400. Tell me, is it clear, everyone? But now comes the question, how are we going to find the value of impairment of goodwill? Mr. Jeet Sarkar, understand. Carrying amount of net assets of subsidiaries given in the question. Okay. Fair value adjustment of 50,000 given in the question. Now, this fair value adjustment increases the carrying amount of assets, but it is not impacting the tax base of assets. Okay. It is not impacting the tax base of assets. So it gives rise to a taxable temporary difference for which we'll make a deferred tax liability at the rate of 30% of 50,000. That is 15,000. So deferred tax liability is a liability. So it will reduce the net assets. So 747,600 plus 50,000 minus 15,000 is your net assets on date of acquisition. Is that clear, everyone? Is it clear, Jeet Sarkar? Now comes the question is how to calculate the impairment of goodwill. So now see the question here. The question is giving, sir, don't we take the impact of depreciation of increase in the fair value of asset? Very good point, Mehak. But understand, Mehak, depreciation comes on what date? It comes in the post part, not on date of acquisition. Right? Excess depreciation due to fair value adjustment comes on the post part, post acquisition profits, not on the date of acquisition. Here we are calculating on everything on date of acquisition. Is that clear, Mehak? Is that clear, Mehak? Okay. Now, working note number 2. Here we have to calculate the amount of goodwill impairment. Goodwill impairment. How to calculate that? So now question, see, the question is giving you the valuation of goodwill, opening and closing. This is opening goodwill, this is closing goodwill. Now see here, opening goodwill is how much? Opening goodwill is how much? This much. Now goodwill on acquisition of Trudos is how much? 37400. Okay. What should be the value? Okay, sorry. So what should be the value of goodwill? It is equal to this plus this. This should be the value of goodwill. But what is the closing goodwill in SOFP? What is the closing goodwill in SOFP? Just see. 447,400. So what is the amount of impairment? This minus this is the amount of impairment of goodwill. This is called as goodwill impairment. This is called as goodwill impairment. This is called as goodwill impairment. Tell me, is it clear, everyone? Is it clear, everyone? Now tell me, what is the treatment of goodwill impairment? Now, since the question says that the consol SOFP, consol P&L and consol other comprehensive income is completed and correct, meaning thereby this goodwill impairment would have been recorded in this profit before taxation. This goodwill impairment would have been adjusted in the profit before taxation. Tell me, is goodwill impairment a cash flow item? No, it's a non-cash expense. It's a non-cash expense. So don't you think I will adjust goodwill impairment here? Goodwill impairment here. I will add back goodwill impairment here. I will add back goodwill impairment here. I will add back goodwill impairment here. Right? So now understand, guys, never Never ever you dare to touch this column. Never ever dare to touch this column, the highlighted column. Never, never, never. Just insert a column for adjustments and do all the adjustments here. Do all the adjustments here. Okay. Now, what is the amount of goodwill impairment? 31100. So right here, 31100, working note number 2. Okay. Working note number 2. Tell me, is it clear, everyone? Is that clear, everyone? Okay. Now, moving down further. Moving down further. Working note number 3. Working note number 3. Understand. Let us see here. Any further thing. Profit before tax is correct. Depreciation is correct. 625060. Question was also saying same amount, right? Depreciation charge of the group is 625060. It is correct. Fine, ठीक है. Goodwill impairment we adjusted. Now increase in inventory, trade payables and trade receivables. Let me explain something. Just a minute, guys. Just a minute. Let me come to my notebook. Okay, now let me explain something. Console cash flow. In the opening, 1st January 20x5, year end is 31st December 20x5. Let's suppose, understand, here it was only, this company name is Kabilo. Here it was only Kabilo. And here it is Kabilo plus Trudos. Tell me yes or no. Come on, guys. I need your response. Here it is Kabilo plus Trudos both. Now, understand. Let's suppose Kabilo had an inventory of 10. Okay. Now here Kabilo had an inventory of 15 and Trudos had an inventory of 3. So what it becomes? 18. Now, what is the question saying? Read the question. If you read the question, I am taking you back to that screen. If you read this question, see here. How have we prepared? How did we prepare console cash flow? We have prepared the console cash flow, the statement of cash flow figures for movement in inventory, trade receivable, trade payable, property, plant equipment was calculated simply by taking the difference of opening and closing. Simply we have taken the difference of opening and closing. Now tell me, meaning thereby we have told, what we have done is 10 to 18. We are saying increase in inventory by 8 is what we have done. Tell me, is that correct? Tell me, is that correct? Is that correct? Now what happens here is, what we are saying is this 3 of Trudos is a cash outflow. But for acquiring the inventory of Trudos, is there any cash outflow? No. See, for acquiring the entire Trudos company, there is a cash outflow. I understand. I will definitely consider that part. Okay, but understand, for acquiring inventory of Trudos, did I pay any cash? Have I paid any cash? No. Is that a cash flow item? No. So do we need to consider this 3 also? No. So what we need to do? We need to remove 3. Right? So now what we need to do here is come back to the screen. Desktop sharing. Okay. So what we need to do is, from the working capital adjustments, and so from PPE, inventory, trade receivable and trade payable, all these 4, for all these 4, we need to remove the impact of these. Are you understanding this part? We need to remove the impact of these. We need to remove the impact of these, right? So now let us remove it off. Inventory 256,800. Come to spreadsheet. Inventories. It is saying negative, means it is increase of inventory. So we have to remove it. So we will write it different sign. We have to see, we have to reduce these figures. So we'll just write the opposite sign. Okay. So now what is the amount? Tell me. In inventories, we will write here how much? 256,800 plus 256,800. In trade and other receivable is 22030. So plus 220300. Just the opposite sign, because we have to reduce these things. Now trade and other payable. How much is trade payable? 175,400. 175,400. So we have to see, it's the plus sign. So I will write here minus 175,400. Is that clear, everyone? So now we have done the adjustment for these three. We are yet to do the adjustment of property, plant and equipment, but we have done the adjustment of these three. So now can you please calculate the final figures? Profit before tax is this much. Which is correct. Why this figure is not changing? Why I am unable to increase the size of it? Okay. Group cash flow. Yeah. Now, so this is the amount. Okay. This 31,100 is the amount. Now here it is negative 658,100 plus 256,800 negative 211,500 plus 220,300 220,300 220,300. Okay, now 93,900 minus 175,400. Now 175,400. Now see here, guys. Now see here. This one, the sign has changed from negative to positive. So it is called as decrease. We have to write here decrease. It is no more an increase, it is decrease. Now the sign has changed from positive to negative. So it is called as again a decrease. Okay. So this is the done. Now, what is the cash flow generated from operating activities? Can you please add everything? Sum. Okay. Done here till here. Okay. Now we need to find the tax paid. So in the question has given us the amount of tax expense, but we need to find the amount of tax paid. See, the question has given us the balance of current and deferred tax opening and the closing liability. So we know the opening, closing liability, we know the expense. Can we calculate the amount paid? Okay. So now let us come here. Working note number 3. Tax paid. So what is the opening liability? Opening current tax liability. Okay, opening deferred tax liability. Add what is the tax expense for current year. Okay, add what is the deferred tax on fair value adjustment. Okay. Now, what is the closing balance? What should be the closing balance? So let's write the figures first of all. Let's write the figures first of all. Opening is this one, right? Yeah. 250, this one. Copy and paste. It is current, deferred and current. Okay, ulta ho gaya. I'll write here. Upar. Paste. Done. Now, what is the tax expense for the current year? Let's read the exhibit. Tax expense for the current year is 385,600. Okay. 385,600. 385,600. What is the deferred tax on fair value adjustment? 15,000. Okay. Now, what should be the closing balance? It is equals to sum. This one. Now, what is the closing balance? Closing current tax liability. Closing current tax liability and deferred tax liability. Let's consider both together. Closing this plus this. It's 494,300. So what is the amount of tax paid? What is the amount of tax paid? This minus this. 413,200. Is that clear, everyone? 413,200 is the amount of tax paid. Okay. See, guys, how am I doing these calculations? Just keep in mind the T account in your. Just keep T account in your mind. Okay. Just keep T account in mind. See, wait. I will come on the screen. Wait. So in the T account, what we do? In the credit side, opening liability. Below that, P&L expense. In the debit side, we write C by D. The difference is bank account. Difference is bank account, right? That's what I've done here. Opening plus expense for the current year compared with the closing. The difference is called as. The difference is called as tax paid. Is that clear, everyone? Are you understanding it? Are you understanding it? Okay, chalo, done. So now this tax paid of 413,200, we will adjust here. We will adjust here. Working note number 3 here. Working note number 3. And I will write here minus 413,200. This is my cash flow from operating activities is equals to this plus this. Is it clear, everyone? Come on, guys, tell me. Is it clear, everyone? So now operating activities sorted for everyone. Operating activities sorted for everyone. Okay, sorry, you can't see my screen. Kya? Just give me a minute, guys. I'll change my screen. See, I have adjusted here tax paid. Okay, and tax paid amount, working note number 3, and I have completed my cash inflow from operating activities. Tell me, guys, is it clear? Is it clear, everyone? I need a response from each one of you. Is it clear, everyone, till here? I have changed the screen now. Anyone having any queries in operating activities? Anyone having any queries in operating activities, please confirm. Or if not, I'll move on to the investing activities now. I believe you are getting confidence. I believe you are getting confidence in console cash flow now. I believe you are getting confidence in console cash flow now. Okay, chalo. Moving on to investing activities. Now this PPE. Now, similar to this adjustment, this mistake is there in PPE also. Is there in PPE also, right? But now the question says, if you see the question, it says there were no disposals of non-current asset, but there were some additions by way of cash. Oh, so we need to find out the amount. We need to prepare the PPE account. Okay. So now let's write here working note number 4. Working note number 4. Okay, the table is logged. Is this table logged? Okay, ideally it should not be logged, but okay, no issues. I will write here working note number 4. Is this table also logged? No, right. Okay. Working note number 4 I will write here. Okay, I'll write here working note number 4. Okay. Now, So let us prepare working note number 4. Just keep T account in your brain and solve it off. Working note number 4, acquisition of PPE. Acquisition of PPE. Okay. Now, what is the opening PPE? What is the opening PPE? Okay. Now, minus, okay, or you can say add acquisition of PPE of Trudeau's. Okay. It will reduce by depreciation during the year. Depreciation during the year, which will give me the closing. Now I have to compare with the closing, which will give me the amount of acquisition of PPE during the year. Right? Now tell me, what is the opening PPE? Guys, understand, are you understanding this part, or you want me to show via T account? If you want me to show, I will prepare a T account and also show. But just keep in brain. Okay, let me come on the screen. So if you prepare a T account, I'll show it to you. Just one T account will definitely clear your doubt. This is PPE account. How will you prepare? Tell me. To B by D, to acquisition of Trudeau's, basically the PPE of Trudeau's, by depreciation, by closing. Right? Now, by to bank, because there is no disposal, there is just acquisition. Now, now understand. We know this figure, we know this figure, we know this figure, we know this figure. Can we calculate the balancing figure? So how to calculate? We will do this plus this minus this. Okay, compare this with this to get this. Are you understanding, guys? Come on, tell me. Are you understanding? Going back to my screen. So that's what I've done. See, opening plus Trudeau's less depreciation, comparing with the closing, I will get the acquisition. Tell me, is that clear? Disposal of PP, there is no disposal. Na? See here, there were no disposals of non-current assets. Mr. Bombay airdrop, can we directly prepare T account in the exam? If you want, you can. But how will you prepare T account in Excel file? Tell me. Don't you think it will become too confusing if you prepare T account in the Excel file? It will become too confusing for you and for the examiner both. Rather, just keep T account in your brain and solve it like this. Okay? Arrive at the closing, compare with the actual closing, you will get the difference. Okay? Now, what is the opening PPE? Tell me. What is the opening PPE? 3125300. Paste here. What is the acquisition of PPE of Trudeau's? Come to the exhibit. Trudeau's is 421000. Okay. 421000. But now one more thing. This Trudeau's company is 421000 plus a fair value adjustment of 50,000 also. Right? So here it will be equals to this plus 50,000. Tell me yes or no. This plus 50,000. Tell me yes or no. Okay. Now, what is the depreciation during the year? Depreciation is 625060. Okay. So what is the closing sum? Is this one? What is the closing figure? What is the closing of PPE? What is the closing of PPE? This one, copy, paste. Now, can you please compare this with this? Is 627660, 697660. Is it clear, everyone? Tell me, guys. Is it clear, everyone? Tell me, guys. This is closing, right? Opening is this one, closing is this one, right? So opening plus acquisition of Trudeau's figures we have taken correctly. 421000, yes. Depreciation, 50,000 also we have considered. Yes. Minus depreciation is the closing figure, and this is the closing, this is the acquisition. Tell me, is it clear, everyone? Now, this comes to 697,660 is the here. Where it is? Here. Oh, sorry. Minus this one. Clear? Is it clear, everyone? Is it clear, everyone? Now comes consideration paid for acquisition of Trudeau's company. Tell me, so now this is a cash flow statement. What is the cash that we have paid? What is the cash outflow on acquisition of Trudeau's? What is the cash outflow on acquisition of Trudeau's? 400,000. But now tell me, this is the cash outflow when we acquire Trudeau's. This is the cash outflow when we acquire Trudeau's. But understand, when we acquire Trudeau's, there is a cash balance in the Trudeau's also. There is a cash balance in the Trudeau's also. So we need to consider that as well. We need to consider that as well, right? So now where is the cash balance of Trudeau's? Cash balance is 24900. 24900. So it is equals to 400,000 minus 24900, which is equals to how much? 400,000 minus 24900 is equals to 37500. It's an outflow. It's an outflow. This is an outflow. This is an outflow. Okay. Now, what is the cash outflow from investing activities? This plus this. Done. Now, there is a query coming up in this one. Sir, here also we don't take the impact of additional depreciation of increase in the fair value of the asset. Mehak, please understand. The question is saying what? Read this one. The group financial controller has accurately completed the console SOFP and the console P&L. Means the depreciation in the console P&L is correct. What is the amount in the console P&L? 625060. So it means it includes the excess depreciation on fair value adjustment. It already includes excess depreciation on fair value adjustment. Okay? It already includes excess depreciation on fair value adjustment. It already includes that amount because the group financial controller has correctly prepared console P&L. See, this is what they written. The group financial controller has accurately completed console SOFP, console P&L, right? So it is correct amount. It is including that. Now, so this is what is the cash outflow on acquisition of products. Now, this is the investing activity that we do. Tell me, is it clear, everyone? So this completes my cash flow. This completes my cash flow. If this line is not written, then we adjust or not. Okay, so understand, if this line is not written, and if the question says that the fair value adjustment is not accounted for, if the question says fair value adjustments are not accounted for, then we will account for it. Yes, we will account for it. Okay, we will account for it. Okay, but for doing that accounting, Mehak, we need to know the remaining life of this asset. We need to know the remaining life of this asset. Is the question giving us that data? Tell me, Mehak, tell me, is the question even giving us the data in that case? No, question is not giving the data only. What is the remaining life of the plant? Is the question anywhere giving the data? No, question is not giving that data. So even if we want to, can we? No, we can't. So this is the group cash flow. Okay. Tell me, guys, are you understanding this part? Are you understanding this part? This discussion of group cash flow, I believe, has given you confidence. This discussion of group cash flow, I believe, has given you confidence. Okay. I am coming back on the screen. Okay, now, so coming to the first part. So what is remaining now? So I have discussed this part as well, group cash flow also. Now I have to discuss two things. Foreign subsidiary and joint operations. Foreign subsidiary and joint operations. So for foreign subsidiary also, I have, rather than discussing theoretical things, I have taken up an example. I have taken up an example which I discuss in my regular class also. Okay, I will explain that example in brief fadafat with you guys. Okay, now, how do we account for working capital movement at the time of disposal of subsidiary? Mr. Abdullah Noman, understand, we apply the same logic. Okay, that is, in the opening it is parent plus subsidiary, in the closing it is only parent. Okay, and accordingly we adjust the working capital. So think logically, don't do ratify. Okay, Noman. Now, let us discuss foreign subsidiary now. So I'm explaining this case of foreign subsidiary by help of an example. So first of all, I will explain the question and then I'll discuss the treatment also. Okay, understand now. Let us understand the question first of all. Just a minute. Guys, can you see my screen properly? Okay, chalo. Let us discuss this foreign subsidiary example. Okay, now. So Dragon Company is the parent company. It has acquired a foreign subsidiary called as Tattoo Company. Okay, now the functional currency of Dragon is dollars. I believe you understand the meaning of functional currency. Okay, the functional currency of Dragon is dollars and the functional currency of Tattoo is DN. Okay, now foreign currency, functional currency of Tattoo is DN. Now understand, it's a foreign subsidiary. The question is further giving you that we have acquired 90% shares of this company on 31st December 20x0. On 31st December 20x0. Safal, I was here to explain only the console cash flow part. Okay. The exhibit number 2 pertains to financial instruments. Okay, my intent was just to discuss the financial instruments. Okay, sorry, console cash flow. Console cash flow, and I have discussed the entire logic of every calculations which I have done, right? I have discussed the logic of all the calculations I have done. So I believe the part 2 of explaining your workings you can do. Question number 3 from the financial instruments you can do. Okay, my intent was just to explain the entire thing for a console cash flow from a question. Okay, considering it is a revision session, won't be possible to write each and everything in the session. Okay, so I'm just focusing on the concepts now. Okay, some concepts via theoretically concepts, some via questions. Like for example, cash flow was an important stuff, so I explained with the help of a question. Foreign subsidiary is an important stuff, so I'm explaining with the help of a question. Now, so understand, Dragon Company, a parent company having dollar as the functional currency. Tattoo Company, a foreign subsidiary of Dragon, which Dragon acquired on 31st December 20x0. 90% was acquired and the investment made was 180 million DN. 180 million DN. Okay. Now on the date of acquisition, retained earnings of Tattoo was 65 million DN. NCI at fair value was 14 million DN. So now understand, whenever it is a case of foreign subsidiary, keep in mind two things. That when you calculate goodwill, first of all calculate goodwill in foreign currency, then convert the goodwill to functional currency. Okay. Now, similarly, first of all, prepare the statement of net assets in foreign currency, then convert the statement of net assets to functional currency. In the process of converting goodwill and net assets from foreign currency to functional currency, you will come across a exchange gain or loss. You will come across exchange gain or loss. So basically, in case of foreign subsidiary, you need to understand the treatment of this exchange gain loss. That's the only thing which you need to study in foreign subsidiary. Rest everything is same. Rest everything is same. Rest everything is same. Okay. Now let us see. So I have drafted a question on my own. Dragon tattoo foreign subsidiary. So now on 31st December 20x1. So understand, this is the date of acquisition. This is the reporting date. There is a 1 year gap. There is a 1 year gap. Now on the reporting date, you have been given a small P&L. The question says that goodwill is impaired by 10%. Now SOFP is given for both the companies also. So I have taken a P&L, SOFP both. Now, exchange rate is given on the date of acquisition, average, and the reporting date. Question is asking you to prepare console P&L and console SOFP. Question is asking you to prepare console P&L and console SOFP. So now, how to do that? So working note number 1. Your working note number 1 will be your statement of net assets. Understand? Statement of net assets. So now tell me, first of all, prepare statement of net assets in foreign currency, that is in DN. Then convert to functional currency. See, first of all, we prepared it in DN. We arrived at the DN figure. Now the net assets on date of acquisition will be converted using the exchange rate on date of acquisition. Okay, now the net assets on reporting date will be converted to functional currency using the exchange rate on reporting date. The post acquisition profit will be converted to functional currency using average rate, using average conversion rate. Okay, now in arriving at this, see, opening plus post acquisition profit should come to closing. So what is the amount? 23.33 plus 57.7 should be 81.03. But what is my closing? 110. So what is the difference? 110. Difference is 28.97. This is called as exchange gain. This is called as exchange gain. Is that clear, everyone? Is this exchange gain calculation clear to everyone? Is this exchange gain calculation clear to everyone? Is this exchange gain calculation clear to everyone? Okay. Now, I'm removing this part as of now. Sorry. Coming to goodwill. So first of all, calculate goodwill on in the foreign currency, then convert it to functional currency. Now, so what was the value of investments in foreign currency? 180 million DN. What was the value of NCI in foreign currency? 14 million DN. Now, what is the value of net assets? So it was given in the question 70. How come 70? See, it is given. See, retained earning is 65 and share capital is 5. So 65 plus 5 is 70. It is 70. So it is in DN. So the goodwill in foreign currency is 124. Now what is the impairment of goodwill? What is the impairment of goodwill? 10%. So what is the impairment of goodwill here? 12.4. So what is the value of goodwill on the reporting date? 11.6. Now goodwill on date of acquisition will be converted to functional currency using the acquisition date exchange rate. Goodwill on reporting date will be converted to functional currency using the reporting date exchange rate. Impairment loss will be converted to functional currency using the average exchange rate. Now, understand, date of acquisition goodwill minus impairment loss. What is the value of goodwill? 41.33 minus 4.77. It comes to 36.56. Okay, but my goodwill is how much? 55.8. So what is the difference? Difference is 19.24. Difference is 19.24. This 19.24 is called as exchange gain. There is an exchange gain of 19.24. Tell me, is it clear, everyone? Is this exchange gain of 19.24 clear to everyone? So far, what I have done is, first of all, I have prepared the statement of net assets in foreign currency, converted it to functional currency, calculated exchange gain loss. Similarly, first of all, I calculated goodwill in foreign currency, converted it to functional currency, and calculated exchange gain loss. Is it clear to everyone till here? Is it clear to everyone till here? Come on, guys, tell me. Is it clear to everyone till here? You will appreciate how easy it is to solve a question on foreign subsidiary. You will appreciate this. Let me write the amount of gain also. 28.97, 19.24. Both are exchange gain. Both are exchange gain. Okay. Now nothing else. Just come to NCI and P&L. Okay. Let us forget NCI as of now. Come to NCI and console RE. Just hold it as of now. Come to console P&L. Come to console P&L. Okay. Now, how will you solve console P&L? How will you solve console P&L? So console P&L, you will solve it like this. Opening. So parent ka P&L plus convert the subsidiary ka P&L. Convert the subsidiary ka P&L to functional currency using the average exchange rate. Using average exchange rate. What is the average exchange rate? 2.6. So let us convert. See, parent convert subsidiary, parent convert subsidiary. This is the profit. This is the profit. Now, in other comprehensive income, we record the exchange gain or loss on net assets and on goodwill. 28.97 and 19.24. Is console P&L a difficult task? Is console P&L a difficult task? Tell me. In console P&L, take the P&L of parent plus convert the P&L of foreign subsidiary using the average exchange rate, and whatever is the exchange gain or loss on net assets and goodwill, record that in other comprehensive income. Record that in other comprehensive income. Tell me, is that clear, everyone? Tell me, is that clear, everyone? Come on, guys. Is that clear, everyone? Wonderful. Now, come to console SOFP. Now, how will you solve console SOFP? Parent ka SOFP plus subsidiary, foreign subsidiary ka SOFP converted using closing rate. What is the closing rate? Tell me, what is the closing exchange rate? What is the closing exchange rate? What is the closing exchange rate? 2, right? See, 2. So now PPE is sorted. Now goodwill, hold on. Current assets is sorted. Liability is sorted. Liability is sorted. So now equity of parent will come up here. So this is not a challenge, right? So understand what is sorted here. PPE, just a minute. PPE is sorted. Current asset is sorted. Equity is sorted. Now liability is sorted. Now goodwill we have calculated already. Goodwill we have calculated already 55.8. So goodwill is also sorted. Goodwill we have calculated 55.8. So goodwill is also sorted. Goodwill is also sorted. Investments will not come in console. So it is also sorted. So now what is challenge? So basically asset side is sorted. Now come to equity side. Equity side. What is not sorted is retained earnings, FCTR and NCI. So now what the question says, now what the standard says, this exchange gain or loss, this exchange gain or loss, the treatment of the exchange gain or loss. You have to understand the treatment of this exchange gain or loss. You have to understand the treatment of this exchange gain or loss. Treatment of exchange gain or loss. Now, exchange gain or loss can come on net assets, can come on goodwill. Okay, first of all, it will be recognized in other comprehensive income. It will be recognized in other comprehensive income. From there, in SOFP, parent's share will be accumulated in foreign currency translation reserve. NCI share will be accumulated in NCI. Clear everyone? Now for goodwill. So now here we need to see if NCI is at fair value method or if NCI is at proportionate share method. If NCI is at fair value method, then what we will do is parent share we will accumulate in foreign currency translation reserve and NCI share will accumulate in NCI. But if the NCI is at proportionate share method, then we will record the entire amount in FCTR itself. Is that clear, everyone? Is that clear, everyone? Now, in this question, NCI was at fair value method. In this question, NCI was at fair value method. So what we will do while calculating SOFP, we will allocate the exchange gain or loss. We'll allocate the exchange gain or loss to parent and NCI. Parent share will get accumulated in FCTR and NCI share will get accumulated in NCI. So that's what I have done. See, while calculating NCI, I have taken exchange gain on net assets. I have calculated exchange gain on goodwill. Right? Now, similarly in RE and FCTR, I have taken up exchange gain on net assets, exchange gain on goodwill. Proportionately I have done, and final figures of I will write here. This is what is the final figure which will come up here for retained earnings, FCTR and NCI. Tell me, is that clear now? Is that clear now? Foreign subsidiary. So the whole treatment of foreign subsidiary, revolves around only two things. That is this one. The whole treatment of foreign subsidiary revolves around this calculation only. Is that clear to everyone? Come on, guys, tell me. Is that clear to everyone? Come on, guys, tell me. Clear? Coming to here, we have discussed foreign subsidiary also. Now comes the last thing, that is joint operations. So for that, we need to discuss first of all joint arrangements. What is the meaning of joint arrangements? Okay, what is the meaning of joint arrangement? So it's an arrangement between two or more parties that have joint control. What is the meaning of joint control? Joint control means the parties to the arrangement has unanimous consent. Okay, no single party should have the individual control. Now understand, joint arrangement can be of two types: joint operation or a joint venture. Now, how to understand whether it is a case of joint operation or a joint venture? So for that, the standard says, okay, is the joint arrangement structured? Structured means, is there any separate entity that we have opened for the same? If it is yes, then we have to see the parties to the arrangement have the right to specific asset or specific liabilities. Yes, then it's a joint operation. If the parties to the arrangement have right to net assets, then it is a case of joint venture. If there is no separate entity that is opened, then it is a case of joint operation. Now understand, the treatment of joint venture is discussed under IAS 28, that is similar, exactly same treatment as that of associates. So joint venture is accounted for under equity method, but joint operation is discussed under IFRS 11. And under joint operation, what is the treatment that we do? We record our share of assets, we record our share of liabilities, we record our share of income, we record our share of expenses. Okay, we just record our share of assets, our share of liabilities, our share of income, our share of expenses. That's all. Okay, that's what is called as joint operation accounting treatment. Now there is a theory part which you can do on your own, which I'm not discussing now further. One strong recommendation for you guys. See, I have helped you in the revision of the group cash flow. The pain points of the group accounting I have discussed with you. Okay, but understand, in my YouTube channel, if you go to the playlist section, you will find the playlist for ACCA SBR, wherein you will find multiple resources. Just see the entire revision of ACCA SBR in 15 hours. The revision of the entire ACCA SBR syllabus, plus super 30 questions. Sustainability stands again become a very important point. Okay, now exam technique, basically the analysis of the examiner report. Okay, how to deal with pre-populated spreadsheet, though it is not required to watch this video now because I have already explained this part to you. Okay, now dividend treatment. Okay, how to discuss the ethics part. Now there are certain set of mistakes. See, here come. I have identified a set of around 25 mistakes which you could do in group accounting. Okay, I have already posted a video of the same, the group accounting of mistakes. Okay, group accounting mistakes. I strongly recommend you to watch this video. Because after watching this video, definitely you will understand a lot of mistakes which you would have done in the exam, but you will not definitely if you after watching this video, you will not repeat those mistakes in the exam. Swayam, I will recommend, in the last day of the exam, that is on 4th of June, don't watch any video. Neither mine or any other videos. Don't watch any video. 4th June should be for only and only self-study. 4th June should be only and only self-study. Whatever video you have to watch till 3rd of June. Nothing after that. Nothing is my strong recommendation. Okay. So in the playlist section, you will find a lot of videos which you can take help of. Okay. Now that's all from my side for the group accounting. I believe you have got confidence in the group accounting chapters. That's all for the day, guys. And I will request all of you to please write your feedback in the comment box post the session. Okay. Now, should we have to answer section A or section B first in our exam? There is no such priority, Mr. Kannada Blasters. Okay, now, so there is no such priority. You can answer according to what suits you the best. Okay, you can answer according to what suits you the best. What should you study in the last 4 days? So understand, Mr. Hiday, a very good question. So in the last 4 days, read as much as you can. Sir, what to read? Read suggested answers. Don't practice questions. Okay, don't practice questions. Okay, just read as much as you can. Read suggested answers as much as you can. Okay, pre-populated spreadsheet one you solve. Rest all you just read the answers. The more you read, the better answer you will write in the exam. The more you read, the better answers you will write in the exam. Okay. Don't try to test yourself in the last 4 days. Just read as much as you can. Okay. And one strong recommendation, don't watch any video on 4th of June and 5th of June. That should be wholly dedicated to self study only. Okay. Yes, Christopher. Thank you guys. Thank you. Bye bye. All of you, please do write a feedback on the session. Okay. After the session ends. Thank you guys. Bye bye.